All right. So yeah, so we said we are doing gearing up for the crash. So why do we do this class? Well, because of what I do for a living, right? I get asked all kinds of questions. And a very common question is, Keith, is the stock market going to crash? Or Keith, what's going to happen to the stock market? And, a lot of times when people ask me that kind of question, it's really because we're human and we want to be able to control things. And so you want to know, should you be doing something? Should you get out of the stock market? Should you make changes to your portfolio? And so because we're asked that a lot, we think this is a great class to do for everybody here in the room. So as I say that, here's the problems when you ask me that question. Well, the first question is this: nobody knows when the stock market's going to crash. Right? And we'll talk more about this as we go through the discussion, but that's a problem. And as a result, due to the things, due to the media, due to our human emotions, due to all kinds of things, people continuously make poor decisions and have behaviors that are really antithesis to what you should be doing as an investor. So we make bad decisions and wrong behaviors. And the third problem is, again, like I said earlier, is that the media and even other advisors, sometimes brokers, even our friends and family, will create an atmosphere of fear and greed. And also, they make you believe that people could predict the future and tell you when a crash is going to happen and when to get in and when to get out and all the things you should be doing in advance. Okay? So we'll continue to address those problems as we go through the discussion. So when it comes to investing, this is kind of that like thinking with the end in mind philosophy. When it comes to investing, none of this talk about a stock market crash really matters. And it doesn't matter for this reason, is that volatility is nothing new. And I'll show you in a little bit how really infrequent actual crashes are. Now, volatility is happening all the time, okay? And also, yeah, markets are going to crash. And like always, they recover and eventually there'll be a boom. That's what they do. It's nothing new. And the problem when it comes to investing, and part of it is trying to time the crash is actually riskier than setting up your investment allocation and diversification correctly to begin with, okay? And we'll definitely hit on that as we go through the discussion. So maybe I'm going to try to get some room participation here. Does anybody have an idea what this is right here? If you want to unmute and just shout it out, feel free to do it. All right. Well, then I'll answer it for you. I think someone like this that they knew, maybe a little shy to talk. There you go, Dean. What is it?
Flight simulator.
Exactly. Thank you. And so what's the purpose of a flight simulator?
Train the pilot so he don't crash.
Exactly. Train the pilot so he doesn't crash, right? So pilots spend thousands of hours in a flight simulator to do exactly that. So when there's turbulence, they're already prepared for it. They know what they're going to do. They're prepared to react and behave, and they know what's going to happen. So what we tell people is attending the investor education and being here tonight, the first thing is that's like you walking into the flight simulator. You're taking an hour out of your life, an hour of your time to train yourself about what to do before, during, and after a stock market crash. Because when you experience turbulence on a plane, you don't jump off the plane. I know you kind of can't, but if you could, I doubt you're going to do it anyway, right? And what we're talking about is the same thing with investing. So like I said, the first thing is this is like a get into the simulator. And also, like a plane wing is engineered to withstand turbulence. Yes, the pilot's trained to how to manage the flaps and deal with it, but the plane wing is engineered to withstand turbulence. So a well-diversified portfolio, and we'll show you what that looks like, along with the correct behaviors by you and other people, are designed, if you do it correctly, to navigate through the stock market volatility and navigate through crashes. So let's first define what is a stock market crash. So, it's also referred to as a bear market. A bear market is when the stock market goes down at least 20%. And then that's defined as a crash. On the flip side, a boom market is when the market goes up 20%. All right. So to put it in perspective, since 1926, just looking at the S&P 500, and for all those that know, the S&P 500 is the top 500 largest U.S. stocks in America. And it's a very common benchmark of how people measure how well the stock market's doing. And the other benchmark we'll commonly see is the Dow Jones, okay? But the S&P is what we'll talk about as a comparison because it is the most commonly used. That's what we'll use a lot in this discussion. So since 1926, the S&P 500 has only had a drop, a crash of 20% more just 6 times. Now, this doesn't include the COVID crash. I will talk about COVID later on because the market did drop a lot with COVID, and it's the more recent thing in people's minds. But the reason why it's not in the 6 times is that we're talking about year-long 20% drop in value in the stock market. And COVID crash only lasted about 30 days. So there was 3 times the market crashed that was between 20 and 29% that lasted over a year. Only once since 1988, and that was the crash in the early 2000s, which was the crash, depending on what time frame reference you all have, that was the crash after the tech bubble. So it was a huge run in tech stocks and, new economy, and everything was gonna be great forever, and everything. And then we had a huge crash that lasted 3 years in the early 2000s. Then 3 times it dropped over 30%, and only once since 88, and that was in 2008. And that was the housing, the housing and debt bubble burst. Okay. So really in perspective, we think the volatility happens all the time, but crashes like this are not as common as people think. For the visual people, here's a visual representation of the last 2 crashes. So you can see, let me get the pen up 1 second. Here was the early 2000 crash, right? And then here was the 08 crash. And you can see, I know every time, if you stay in the market and diversify, do it correctly, you get to, the markets have always, again, recovered and gone back up. And we'll show this more another couple of times in different ways as we go on. So bad things, unfortunately, are not new in society. So this chart right here shows you a bunch of bad things that have happened historically. The Great Depression, Pearl Harbor, World War II, Korean War, Kennedy, our president, was assassinated, the Nixon Watergate scandal, Vietnam, before COVID, there was a SARS outbreak, 9/11, the debt bubble crash, the banks were going to fail. Yet the markets, if you do it correctly, have always recovered and delivered returns, right? So again, it's the behaviors during those bad times which usually derail you from having a good long-term investment experience. Or sometimes, like I show people in our Don't Cheat Yourself class, even if you think you recovered a little bit, you left a lot of returns on the table and missed out on a lot of growth. So another way to show the crashes and the significance or non-significance of it is you'll see here, the orange, that's the 2000 crash, that's the 08 crash. And then here's, again, some crashes, going further back. And like always, it's always come back. It looks the same. And we'll show you a little bit when we talk about the negatives of market timing. If you market time and bail during the crash, we'll show you how a lot of people miss out on a big part of this recovery and sometimes never get back what they lost. So roughly 3 out of 4 years, the stock market is up. Only 1 out of every 4 it's down. 70 years in the history of the stock market, it's been up with an average return of almost 21%. In 25 years, it's down -13. But the point here, again, is crashes are not as common as people think to believe they are. And we'll show you continually how that harms people where they're investing based on when they think a crash might come. So one of the problems as humans, when it comes to this kind of discussions, when it comes around investing, is in many scenarios and many things in life, as humans, our perceptions of things never really match the reality. And when it comes to investing, that is very, very common. So we're going to show you a really good key example of this. All right. So if I have a volunteer, if anyone's willing to, if not, I'll give you the answer. Does anybody here know what is the most common way our government uses to measure the growth of our economy? If anyone wants to just give an answer, it's unmute and shout it out.
GDP.
Our star student team, GDP, which stands for gross domestic product. So there's all kinds of data points that go into this formula, of which we're not going to get into this discussion. But GDP, gross domestic product, is the most common method that they use to measure the economy, the growth or the shrinking of the economy. So if the economy is doing well, if anyone wants to volunteer, how do you think the stock market, what do you think the stock market will do or has done during good economies? I saw Mike go like this, thumbs up, right? That's what most people say, right? And on the flip side, if we're in a recession, the opposite is, well, I better get out of the stock market. The economy is bad, right? So that's what I just talked about right here on this slide. So we're going to take a look at that. Right here are points in history where we've had a recession. And right here is the GDP. And these are all negative years of GDP going down this side right here. Okay. In 2009, see, a lot of times it was after the tech bubble burst. So I'm not saying recessions are good, right? During a recession, people are losing their jobs. We're not getting raises. People struggle during bad economies. But again, we're talking about the correlation now and this perception versus reality of the stock market. And most people will react in a recession and they'll bail out of the stock market, right? So 2008, stock market crashes. We are now in a recession where the economy shrunk almost negative 3%. But the US stock market, sorry, it's hard to do a straight line in here, was up almost 25%. In 1991, we had a little dip in the GDP, negative. There was also a recession. Now, a recession, I've researched this before, it's a certain amount of periods in a row where GDP is negative, then that defines a recession. And after that, if it keeps going, it's a depression. All right, so 1991, again, negative GDP, 30% growth. 1982, negative GDP, 14% growth in the stock market. 1975, so you start seeing the last 4 recessions, the stock market grew. Now, there are some negative years, but the point here, hypothetically, I'm not saying do this, if you only invested your money during recessions where the GDP, the growth of the economy shrunk almost 4.3%, you would have gotten 11% return on your investments in the stock market. When you add all the years, which is the good years, the returns actually go down. Well, I'm not saying only invest in recessionary periods, but you have to get out of that mindset. If the economy is good, the stock market's good. If the economy is bad, the stock market's bad. It doesn't correlate. And this is another example of don't always think when it comes to investing, your perception is always going to match the reality. Okay? Makes sense? Hopefully, yes. I'm seeing some heads nodding. Sorry, sometimes it's hard to get the slide going. Now, here are periods, just to illustrate it, of really good, positive growth, positive GDP, and then here's negative S&P, negative stock market returns. And that's why that slide before, we saw the total growth go down in all the years, because again, there's plenty of years where the economy's done well, where stock market returns have done bad. Now I can get into the psychoanalysis of why sometimes we think that happens, but then I'd be here till tomorrow, but you get the gist of it. And again, perception doesn't always match reality. So we talk about behaviors, and here's common feelings we have because we're human. A lot of our human behaviors and feelings are actually counterintuitive to being a good long-term investor. And it's this: when the stock market crashes, it's not fun. We're humans, we run from pain. And when it crashes, we have fear it's going to get worse. And then when the flip side happens and booms, when the market's at an all-time high, people think it's going to go on forever. And the other problem there is, depending on where the all-time high is, this happened in the 90s, and not only the thing that's going on forever, getting back to that second mistake, not being diversified, everybody abandoned diversification, not us, not our clients, but they started chasing, large cap growth in tech, and they got killed in that crash in 2000s. The other problem when a market is on an all-time high is, I also see this, is people are afraid to invest. Well, Keith, I'll just wait to invest until the stock market goes down because I don't want to buy at this high, but then you might miss out on the future high. So, again, these are common feelings we have. We need to try to avoid them. So one of the worst things an investor can do in a down market is panic and sell. And even one of the worst things an investor can do in a boom market, like I just told you, is chase what's doing well. Don't chase a sector. Don't chase, I see people chasing tech and people chasing pharmaceuticals or people chasing, US large, or just don't chase. Because behavior and the wrong allocation and not being diversified correctly, and we're going to show you later on how to do it correctly, that's the problem. Not the crashes, not the volatility. All right, let me say that again. It's your behaviors, as our human behaviors, and the wrong allocation, diversification, that's the problem, not the crashes. And here's an example of that. Okay, there's a firm, an independent firm called Dalbar, that the mutual fund companies hire every year to do this research. And every single time they come out with these numbers, it's always the same story. And what Dalbar does is mutual fund companies are able to track money flowing into their mutual funds and money flowing out of their funds. And as a result, they're able to determine what investors are actually getting as far as returns, right? Just because a mutual fund annual return is X, doesn't mean investors got it if them or their advisors are getting in and out of funds at different times, okay? So in this time frame, and again, like I said, every time this is updated, past time frames, it's always the same story. The average person, the average investor, got a 6% return in the US market, where if they just owned the S&P and stayed put, they would have gotten almost 11%. So the only reason why you can parlay 11% return to a 6 is by market timing, getting in and out, or somebody stock picking in your portfolio, okay? On the flip side, down by there, you see that the bond investors got a 0.3, yet the bond return was almost 6. Same thing, and that just shows you, not only are they getting in and out of market timing, what they're doing is they're going from stocks, and then when it's bad, they're going to bonds. And when it gets good, they get out of the bond and they go to stock. Violating number one rule of investing, they're selling low and buying bonds, and then it comes back up, they sell their bonds, and they buy what they sold back high, okay? So that, again, is due to behavior, mostly. So I said it in that last slide. One of the most common behaviors we see is market timing. Market timing is getting in and out of the market, or not just in and out of the stock, going from stocks to cash or stocks to bonds. Market timing can also be, abandoning international and going all US, all right? Or getting out of small caps when you don't think they're going to do well, and then get back into it when you think they are. That's market timing. right? And market timing is one of the 3 warning signs that we call speculating and gambling with your money. The other one is stock picking and track record investing, all right? And the other problem, if people in this room are saying, well, I don't market time, Keith. Now, if you're a client of mine, you also know I don't market time. But I do see other advisors market time all the time. I have advisors that I know during crashes will say, Keith, how the heck do you keep all your clients' money in the stock market right now? And I say, well, here's one of the reasons. I educate my clients to do it right to begin with, and I know how dysfunctional market timing is. Because you have to be right to get out, got to be right to get back in. All right? And for people who don't think their advisor's doing it, and some advisors aren't. I know I definitely don't, and some other advisors don't. You need to look inside your products. Back to that Dalbar study, one of the other reasons why people have poor returns is not only because they're market timing, because the active managers inside their mutual funds are also market timing. So let's illustrate that a little bit. In this time frame, there was between April 1st and March 31st, 2021, there was 5,000 trading days. And this is another slide. I can go back, the same slide, every time it's updated, and it's always the same story, all the past time frames. If you had put $10,000 in the S&P 500 and left it alone, it would have grown to 50 grand, almost $51,000. But if during volatility in that time frame, because I think there might have been a crash on time frame, but during any volatility, if you got out and and one thing people don't know in the stock market, a lot of times returns they come fast and furious. So even like, when you hear, oh, the market's at all-time high, it's an all-time high, at that point, sometimes it's very little increments, but somewhere along the way, there's usually big jumps and they come in small windows and fast and furious. So if you missed just, in this case, the 5 best days in this time frame, you would have parlayed your 50 grand into 32. Now, I'm going to use COVID as an example a little bit, which is the far right 30-day column. Because most people, when the stock market crashes, they don't just wait to the first day up. They kind of wait to see how long and if the upswing is going to last. So if you bail out or your advisor bails out or the active manager in your mutual fund or product or separate managed account bails out and they miss the best 30 days, they would have parlayed in their US fund 51,000 down to almost 9. Right? And a good example, I'll talk more about COVID in a little bit. COVID was a crash that lasted a month, right? So March showed up, they closed the economy, they closed businesses, this new virus was out. It was, wasn't a very positive time. That was March. Now, if you're one of those people, your advisor or an active manager bailed out due to that, you'd think within 30 days they were getting back in, it was just as bad. But the market recovered a lot. But if you didn't get back in, there's an example of how market timing can be very dangerous because you would have lost significant amounts of growth and almost been very difficult, if ever, to recover those losses. All right, make sense? Yes? Cool. But I know what people are thinking. Yeah, and I know, Keith, I shouldn't be doing it, meaning you, the people in the class tonight, and maybe my advisor shouldn't, but what about the experts? Again, back to those actively managed products, right? They sure could do it, right? Now, in our Don't Cheat Yourself class, we go over the statistics, and this is common knowledge, that statistically, the active managers themselves don't beat the benchmarks on an annual basis. Almost half of them don't. And the half that do generally do not repeat. But we're human, right? Human behaviors and human mindsets, we still want to think people can do it. So let's go to that '08 crash. If you were fortunate enough to be in the top 30 actively managed funds, after that '08 crash, you still would have had a positive in the US market 4.5% return. Now, this is all their peers. So yeah, in this window, they beat their peers. That's the rest of all the other active managers who had a -2 after that 5-year time frame. And the S&P was a -2.19. So if active managers or people can do it consistently in market time, what would you think would have happened in the following 5-year period? You would think, again, I'll answer that for you all. You would think they would repeat, right? Sorry. So here's the following 5 years. So what you'll see is this. The top 30, the following 5 years in the US market delivered a 6% return, while all their peers delivered an 18, and the S&P delivered an 18 also, pretty much. So again, market timing is not an effective way to invest. And getting back to that previous slide, the most common reason why they didn't get those returns is back to they missed some of the best trading days. So even the experts can't get it right most of the time. And to think you're going to be with the ones that do, that's a behavior that derails people from a prudent investment strategy. So here's the COVID crash. Now this is when I was in a class, an advisor session, and they were showing this slide. So I grabbed my phone real quick and took a picture of it. And so for my clients here who are invested with us, this is your actual returns in your portfolios. Okay, so this is right here, the all US fund. So the all US fund in March had a -42%. No, I'm rounding up. Now, as you know, here's the categories in that US fund, and it shows you how each category did. So if you, the client, or if you're not a client, people in the room, in your funds, another illustration here, hopefully it was similar, not the losses, but the fact that this happened, or the people in your products panicked and bailed and got out of the stock market, April, it came roaring back. Right? It came roaring back, and your all US fund from the bottom of the crash over the next 12 months delivered a 109% return. Okay? Now, I talk about diversification. We're going to hit it on a little bit later on. So here's a great example of why being diversified also helps, right? Because I see a lot of portfolios heavily weighted in US large, right? Still a great return, right? But the people who know me, during the years that small caps weren't doing great and micro caps weren't doing great, and value stocks weren't doing very good, I said, don't worry about it. We're buying it on sale. Stay disciplined. Well, we got rewarded for that, and that's how those categories did. Okay? But the point is here again, we're talking about market timing. And if you or somebody else market times, there's a great example of what would have happened if you bailed and missed some of the best trading days after the crash. You would have lost those returns and almost made it very difficult for you ever to recover them. So I talked about the problems, 2 of them, right? No one knows when a crash is going to happen, right? And poor decisions and behavior is really what derails people from a prudent investment results and really peace of mind. The third problem, again, is the media. And sadly, sometimes other advisors and brokers and people, right? Your neighbors, your friends, your family. Not that there are problems in other areas, that's a different story. But when it comes to investing, they could be, they can create an atmosphere of fear and greed as well, right? So these people, the industry, the media, the advisors, people create this atmosphere of fear, right? When's the crash going to happen? What should I do? And greed, right? Where should I put my money? What should I chase? Should I go to Bitcoin? Should I buy gold? Should I buy more tech? I get a lot of quiche. I load up on pharmaceutical stocks, right? And then again, that other problem is they also make you believe that if you can't know, that other people can. And we continually tell you that nobody knows. So let's kind of give you some examples. Okay, first, before I give the examples, again, it's that dysfunctional narrative really that destroys people's peace of mind. It's that fear, that pessimism, and that greed it sells, right? So without that fear and that pessimism and greed, you're not going to click. You're not going to buy the magazine. You're not going to tune into their shows. So here's some examples. And I always kid, like who still gets magazines? But I know at our house, not these magazines, but I know my wife gets a couple of magazines that she still enjoys to read. And I still see them on the shelves somewhere on the food line. It still has a rack of magazines. But Business Week, 1979, the death of equities. I don't know about you, but we all know this, equities still exist. Or the deficit monster. We always have that conversation. I'm not saying deficits are good and deficits are bad. That's a whole other discussion. But back to the fear mongering, we're always being told that the America's economic black hole is this deficit, the death of money, the collapse of civilization, global financial crisis. Didn't happen, so the book went on sale. Okay. The Great Reset, the 2020 recession economic crisis, how to prepare for the market crash. Here's an example of greed. Ben Stein, yes, you can time the market. And if you just buy my book, you can have all this gold and lounge on a chair. Or sell stocks now with exclusive mutual fund rankings. Which funds to buy? So should I sell now or buy? Which one is it? Sorry, sometimes it doesn't move after I do that pen. Okay, Financial Times. This was an article or a website that I saw, I think it was back in, I had the date on here, 2018. And the reason I keep it in here to find it kind of interesting is if you look here, peak as stocks rally. The slowdown in global growth isn't fatal. All right, that's pretty positive. Maybe I should get more in the investing. But then on this side, emerging market sell-off. Investors deliver harsh verdicts on earnings calls. So if companies have bad earnings, that usually results in low stock performance. Emerging market currencies slip after worst week. So again, you're getting both messages is on one page. Good stuff happening, bad stuff happening. Again, creates financial confusion. Here's on Twitter, same place. They would want you to click and read. 2018. The economy is strong, but odds for another recession are 100%. It's going to happen. Just like me, I'm telling you, something's going to happen. We just don't know when. But this person's writing an article trying to predict it. But what's interesting, if you read right down here, it looks like this economic growth has legs. So maybe the recession will happen in a year, maybe two, maybe more. So there he gives his out. No matter when it happens, he can say, well, I was right. Well, yeah, you're right if you have an open-ended prediction. So I think the next one is, let me see here, is a video. Nope, not yet. Stock markets plunge into the bear market territory. Again, more negative news. The next one is the video. I want you to listen closely to what the host says to the person appearing on the show, and then listen to the person appearing, what he says. Oh, as I steal that again, I apologize. Harry Dent, another example. Stock markets crash likely within 3 months. For our returning attendees, you've seen us talk about Harry Dent multiple times. Harry Dent, when we do Don't Cheat Yourself, we show you how many funds, actively managed funds of stock pickers and market timers, that gets closed or shut off due to poor performance. Harry Dent was one of them. He had a fund at AIM that was shut down due to bad performance. He's also written multiple books with predictions. In that Don't Cheat Yourself class, we show you each prediction and the following what happened and how many times he was wrong. Yet he's continually on TV as a guru and expert.
He's saying right now that the crash is going to happen before July.
Oh, okay.
So we'll keep a note of that one.
Yeah. Thank you, Leo. Thank you. So, okay, third time's a charm. Now I think the video is next. So listen to what the person on the show asked and listen to the response by the attendee. Okay, fourth time will be a charm. Another one, S&P tumbles. This was, okay, that's why I added this one today. This was just last week or week and a half ago when the January 24th, excuse me, the stock market tumbled. So again, if you market timed, if you're paying attention, a lot of it has recovered. Fourth time, I promise, will be a charm. Here's the video. Oh, shoot. Oh, you know what? You all can't hear it, can they, Leo? Technology. It's because I'm using my earpiece. Sorry. All right, well, the bottom line of this, I'll paraphrase it for you. She said to the gentleman on the bottom right corner, you've been predicting that there'll be a crash for many years, and it hasn't happened yet. So why are you predicting it's going to crash now? And the gentleman on the right, bottom right says, well, I've been right sometimes. In the crash, it's going to happen eventually. So again, another great example of what, the financial media just portraying things, and these people are just on there as talking heads. Inducing panic and fear is against the law. So I'm not going to show you all these other videos, but here's 22, here's Harry Dent on TV, despite how often he's wrong, talking about the stock market. Here's that video right here I just showed you, right? Mark Cuban in 2016 was talking about he's going to take all his money out of the stock market. And then following that period, the stock market's done great ever since. So if you listen to his advice, you got harmed. Or 2017, worst crash in a lifetime. Again, still hasn't happened. So the point about this part, back to the confusion in the media plays, is this: they are never held accountable, right? If you or someone else takes this advice or takes this and makes an investment decision based on it and are harmed, it doesn't hurt them. They're not held responsible. And the reason is, they're not on here to give out advice and to teach you how to be a prudent investor. Anybody want to jump in and kind of share with me, what is the main purpose of these TV shows and magazines? What's their main function? What are they trying to do? Anybody want to venture a guess?
Generate income.
Generate income. And, correct. And Mike, let me ask you, how do they do that? What's their main way they get income?
Get people to watch.
People to watch.
Advertising.
Bingo, right? If you watch, they make more money selling advertising, plain and simple. So they're not teaching you how to be a prudent investor. They're trying to get you to buy into the emotion of fear and greed, get you to watch, get you to click, and results in them making more money via advertising. So now that we've told you what not to do, right? So what are you supposed to do? How do you gear up for the next crash? You focus on what's most important, right? Time and time again, academic studies fundamental principles of investing have shown time and time again the number one factor to deliver returns is your asset allocation. And I'll show you more what that means, is how do you diversify your money amongst many categories, and inside those categories, are you diversified even further? That's what's most important. So if you're not prepared now for a crash or a boom, which means is your allocation and diversification correct now based on your time horizon, when you're going to need the money, and your tolerance for risk? If you're not prepared now, again, for the crash or the boom, it's too late. The time to do it is not when those things happen, it's now. Right? So your overall approach and strategy before, during, and after a crash or boom is this. Now, for my clients in the room, we're already doing this, so this is going to reinforce what we're doing. For the people not working with us, that's fine. This is what you should be doing. What your other advisors should be doing, or if you're do-it-yourself or on your own. In your IRAs, your 401ks, your education accounts, you name it. You should focus on the proper asset allocation and diversification. And I'm going to show you what that looks like. And eliminate from all levels the stock picking, the market timing, and the chasing. By you, by your advisors, and more commonly, you know if you're stock picking, the market timing, or chasing something, or track record investing. You know if your advisor is doing it. Again, I see advisors more than I would like doing it. Okay? But sometimes I get, Keith, but I'm not doing it. My advisor, I don't think, no, they're not doing it. And then I say, what about inside your products? Well, I don't know. Most people are using actively managed mutual funds or actively managed separate accounts in which someone inside of that product is stock picking and market timing. So you need to eliminate those activities and behaviors on all three levels. And you do that by utilizing passive or market funds. So for an example, instead of using the Fidelity Growth Fund or the American Fund, Euro Pacific, or some other actively managed separate account or mutual fund that's actively managed, you use our index, the S&P 500, or the international is the EFA index. For the people working with me, that's what we're doing. We're using market funds, right? So we're using a market approach in all the categories. And I'll show you visibly what that looks like in a minute. And then once you have the right allocation, you leave it alone, and then you just, as the percentages get out of balance due to each category moving, you're supposed to rebalance back to your intended targets. And then once you do that, you're done. And the only time you should change is when your time horizon changes. So you're 40 years old now, and you're going to retire in 30 years or 20 years. Well, then as you get maybe 8, 7, 6, 5 years before retirement, you should be shifting your allocation down to take away the volatility. That's the approach. That is prudent, academic, fundamental investing. So to illustrate that and to help people out, some of my clients have seen this before. This is a color graph. Here is on the side, I think it's 9 different categories. US large, large value, small stocks, small value, bonds, international large, international small, and cash. And it shows you from 1973 all the way through, this is 2020, the best and the worst category. And if you really study this chart real closely, what you'll realize, what the market timer does or the chaser does, they try to predict what's going to end up over here, which we keep illustrating is almost impossible to do, and trying to predict that, you end up more likely will harm your returns. Asset allocation means you don't try to predict them and you own them all. Again, I know Leo's laughing. It's hard to do the pen with a mouse, okay? You own them all. And I'll show you the pie chart. You see the pie charts all the time from other places. right? And you don't try to guess. And the positive is when you're putting money in your 401k, your IRA, or your matching portfolio, you know you're always buying the worst stuff on sale, which is what you want to be doing, because you know what's worst, based on this chart, always end up at some point being on the best side. That's asset allocation and proper investing. Right? So here's an example. So for my current clients, this is exactly what your portfolios look like. These are all the different categories. So when I say asset allocation, I mean categories. These are all the categories in your portfolios. For my non-clients, you know, your 401k, your IRAs, almost every single place will show you a pie chart for an aggressive investor, a growth investor, a moderate investor, a balanced investor. That's what you should be, that's how your portfolio should look like. Okay? And then in each of these categories, I don't stock pick a market time. Max is not doing it. And in each category, it's a market approach. We own the index or the market. So you have a total of almost 22,000 individual stocks globally invested in 21 categories. Okay. And then I moved the slide to long-term growth. So people ask me, what says 95.5? The first number is how much in the stock market. The second number is how much is in high quality fixed income. So as you go down the scale, you'll see 75%, 25, 50, 50. Now, which portfolio you have, again, depends on the purpose of the bucket and your time horizon and how much volatility you're willing to withstand during the bad times. But you will always notice the allocation, the categories are all the same. The only difference is as you want to get less volatility and less pain during the crashes, you just keep adding more fixed income, right? All the way down to income and growth was only 25% stock. We even have a 0% stock, 100% fixed income. But you always have the 21,000, almost 22,000 unique stocks globally invested in 21 categories. All right, make sense? Yes, no? Awesome. So that's where returns come from, right? There have been studies time and time again that prove this to be correct, right? So the media and the industry will tell you, what we showed you earlier, because they want you to watch and click. The active world will sometimes dispute this. Why? Because if I was telling you, if I wanted your money, or another advisor wanted you to roll their money over to you, or hire them as an investment advisor, the only way in my old day I could convince you, or those people could convince you, would say, well, look, I can pick better managers. I can, take your money from here but over there because I got better stock pickers or market timers. Despite the fact that time and time again, we show that to be dysfunctional behavior and how they statistically don't beat the benchmarks, don't beat their indexes. So proper investing, again, is you choose the right allocation based on time horizon and purpose. And yes, a lot of our clients, people have multiple buckets. Why? Because you might have different pockets of money with different purposes, right? You might have one pocket of money for retirement, another pocket of money for your kids' college. Well, that's a different time horizon. Or if you're retired, one pocket of money for the first 10 years of retirement, another pocket of money, you want to have some growth to keep pace with inflation. So some money might still be in long-term growth or balance. So we know this is not exciting because you're not doing something or active. It's sometimes, scary as an investor to stay put because as humans, we want to feel like we're doing something or somebody is. But it's okay because this is what you do. You don't stock pick, you don't market time, you pick the right allocation, you stay diversified, and then you rebalance. So what rebalancing is once you have the right allocation, things, remember I showed you that color chart right here? Well, if you have the right allocation, when things do good and bad, the percentages of your portfolio change. So no longer has the same allocation. So what rebalancing is, not market timing, rebalancing is if I want 95.5 and I want 20% in US large and 12 in small and this much international. When all that stuff goes different ways, you rebalance back to the targets. And what rebalancing does, on average, it actually lowers your volatility. How does it do that? Well, if you always keep everything that went up and keep it like that and never take that growth off the table and rebalance, well, it always ends up on the other side, the worst category. So if you don't rebalance, you have more volatility when those categories do poorly. In addition, rebalancing on average will add additional returns. How? Because by rebalancing back to your targets, you're by default always selling what's done well and buying what's done bad. Which back to that counterintuitive as humans, it's counterintuitive, right? Because you're running from pleasure, you're taking out of pleasure and you're buying pain, right? But you're doing it because you're getting back to your targets, right? Now, in the macro portfolios, this happens automatically every quarter. They rebalance back to the targets. In your for my non-clients, in your IRAs or 401ks or education accounts or your platforms, a lot of them now are adding the automatic rebalancing feature. So you can usually go on your 401k and set up the automatic rebalance, usually quarterly, sometimes annually. If it doesn't have that, then you have to do it the spreadsheet way. So for my clients that their 401ks don't have automatic rebalancing, what we do in their 401ks, we try to mirror as close as we can to an efficient portfolio like I'm showing you tonight. And then I have a spreadsheet that shows the percentages we want. And then when we meet, we'll fill it in and they'll show us what's out of variance. And then we'll log into their 401k and rebalance it manually. Okay. Oh, COVID and the market crash. By accident, the timing was perfect because for all you know, the stock market crashed in March and the rebalancing happens quarterly. So April, depending on what portfolio you were in, the market crashed so bad, all of our clients, the rebalance saw fixed income buying all the stock categories, right? And then it came roaring back and the next rebalancing was in July, and then the stock was out of balance, and then they rebalanced back and bought more, took off the growth and bought more fixed income. So that was a neat little thing that that we saw by default. That the timing was like, yeah, it worked perfect. It was great. We loved it. So this is the one part that's a little specific, to the matching clients. I just kind of want to illustrate again, what you have. But the next slide, again, we'll get back to, the general theme of the class. Remember, the macro portfolios, you actually have 3 funds: the all US, the all international, and then the all fixed. And then in each 3 funds, that's where you have those categories, right? And then those pie charts I showed you earlier, right? Together, that's how they give you either the 95-5, the 75-25, the 85-15, 50-50, and so forth. Okay, depending on which portfolio you're in, just different percentages. Okay. So this now, again, I know a lot of people ask me, well, Keith, show me the returns. So this is kind of, there's a good slide to illustrate returns. We're always cautious about returns because, again, as humans and not being in the industry, people will see returns and not really understand what they're looking at. So sometimes I always like when my clients call me if they are looking at returns and we have the discussion. A lot of times they'll, sometimes it's, oh, well, you're looking at one category or, it just, it depends on what you're looking at and putting it in perspective and so forth. But that being said, again, here are all the categories in the all equity, all the categories in international, and all the categories in emerging market. So the people doing it yourself, again, US large is right here. That's S&P 500. This is large value. This is small caps. The Russell 2000 could be an equivalent to the small caps. The only negative of that is a lot of mid caps in the Russell 2000. So, but that's sometimes what you can use in your 401k to get the small caps. Sometimes I'll see DFA in 401ks, but the small cap category, you can get it by usually going, some ETFs will buy the small cap category. My Matson clients, the DFA and the Matson portfolio, they're buying only small cap stocks. There's no mid caps in there. But you can see how much stock you have, and you should have diversification, right? So we talked earlier about some people think they're diversified and they're not, right? So one place not diversified, they're missing categories. The other place not diversified is number of stocks. I can't tell you how many times I review someone's portfolio and they'll have the Fidelity Growth Fund, the Fidelity Small Cap Fund, or T Rowe or whatever, and their small cap fund has 82 stocks in it. I don't know about you, but 82 stocks are not diversified compared to 2,000, on top of all the buying and selling going on. Or I'll see a large cap fund that has 110 or maybe 200. That's still not as diversified as the S&P. Or the international active fund having 80 or 90 or 120, even 230, where a market fund will have almost 3,000 in that category. So you can see how much stock, when we talk about diversification, that's what diversification looks like inside the category. So diversification among categories and diversification in the categories. And then you can see your 1 year, 3 year, 5 year, and 10 year returns. Okay? Any questions on this? No? Yes, no, maybe? Okay, perfect. This is the one place where I love being in face-to-face. I can actually see everybody. I can see a couple people on the screen. So hopefully you're all going like this. If not, then raise your hand and ask us. Now here's the fixed income portfolio. So now in the fixed income world, when building a fixed portfolio, you really want to have short-term, high-quality fixed income. And now, unfortunately, the bond market has not been good, and fixed income has had really poor performance for almost a decade now. But it doesn't mean you abandon it, because you're using fixed income purely to bring down the volatility of your portfolio. So remember those pie charts, the 95-5 versus the 50-50, that increase in fixed income is to bring down the volatility, plain and simple, okay? But now, the thing that I look at when I meet new people is a mistake advisors and even active managers make in order to solve the problem of fixed income not delivering really good performance for a while, is I start seeing people overweighting high yield bonds in their fixed income portfolio. Because high yield bonds, they're risky bonds, they pay a high return for a reason. And they usually correlate with stocks. So I've had people come in, oh yeah, Keith, I got a balanced portfolio, I'm 50-50. And then I do an MRI on their portfolio, and I show them the 50% in bonds, half of it is in high yield bonds. And then I show them the correlation of high yield bonds to the stock market is almost the same. High yield bonds are very volatile. So when you have 50% in high yield bonds, a 50% portfolio, whatever it is, if half of it is in high yield bonds, then really only 25% of your portfolio is bringing down the volatility of your stocks. You're really not 50-50, you're really 75 or 80-20, or a different allocation. Hope that makes sense. There's a whole discussion here, but I just want to share it with you. These are all the short-term, high-quality fixed income, what it will look like in a diversified portfolio. So now to illustrate this with some recent crashes, how am I doing time-wise? Sorry, guys. All right, I'll try to, I know we're over 7 o'clock. We started a little late. So I think we're getting, thank you for being patient with us. So hopefully you find this informative, that you want to go a little bit past our time. So here is the 08 crash, the early 2000 crash and the 08 crash. So here are 4 of the portfolios. The aggressive is the 95-5, the long-term growth is the 75-25, the 50-50, and the 25-75. So here's the losses you experience, or these portfolios experience during that crash. And then here is 100% US large. So being diversified, you saved a lot in losses, and then look at the recovery. They did very well, and it even beat 100% US large. And then the '08 crash, 40% loss, right? 30, I mean, pretty brutal in 1 year. You know, the S&P was down 37, but then again, the markets, the funds always recover. And here's another negative year. The point is, again, to the whole theme, you stay disciplined, you don't panic, and you do more harm when you panic because you miss out on those positive returns. I will go through this one. A lot of my clients have already seen this. This just shows you your matching statement. So please always read this over here. Mark does a great job just summarizing what's going on in the markets and then relating it to, efficient portfolio theory, proper allocation, diversification, and what we're doing. And on the right side, if you don't know what you're looking at over here, there's the all US fund. I'm sorry, the all bond fund. Here's the all US fund. And here's the all international fund. And then when I show you the categories, anywhere you see either DFA or iShare, those are the categories. So if you don't know what you're looking at, that's what you're looking at when you see your statements. That's where showing you what either the whole fund did or the individual categories inside each fund. And again, your portfolio is based on which one we chose for you. Yep, the overall allocation or what we chose together. So, assuming you have a globally diversified portfolio of 22,000 stocks invested, you own 22,000 companies all over the globe, what would it take for you to lose it all to zero? Anybody want to jump in with that? Okay. Got a bashful group a little bit. So if you have your money in 22,000 stocks, which in almost all the companies globally, in order for your money to go to zero, it has to be Armageddon, right? Because you're not only in one stock, you're not just in Enron, you own every company that existed for the most part. In order to go to zero, it has to be Armageddon. Or it's very possible, it could be an alien invasion. All right, but either way, hopefully none of those two happen, but we got bigger fish to fry. I'm in the same boat. If 22,000 companies go out of business like that and our money's worth zero, we got bigger fish to fry than what our money's worth, what our accounts are worth. The world is not ending today. Crashes happen. It's the fear and behaviors that are worse than the crash. And crashes create opportunities. Volatility creates opportunities. Why? Because the categories that are down, you're buying them on sale. Like you're putting money in every single paycheck into your 401k or every month into your IRA or through rebalancing. And the booms will happen. They always do. And be careful of the greed during a boom. And booms create pitfalls. I started seeing it again recently over the past couple of years, similar to what happened in the 90s. The boom has been in US large. And so I see a lot of people overweighted in that category. And when that category crashes, like eventually it will, you will have, that's a pitfall for you. Stay diversified. So I don't know when the next crash is coming, and neither does anybody else. Stock markets, both US and globally, they're random and they're unpredictable. Therefore, the appropriate, prudent thing to do is own stock. Don't be afraid of it. That's where your growth comes. Diversify like I've been showing you and rebalance like we've been talking about. And then leave it alone until your time horizon gets shorter. That's it. Otherwise, you or somebody else is your own worst enemy. All right. So I know I said turn off the TV, don't watch that new stuff, but every once in a while, there is a sensible person that does appear on these shows. This is Mark Matson back in 2000. Oh, you know what? I can't show the video because I'm on. So what I'll do is I'm going to, we'll email this presentation to everyone who attended the class and you can watch it yourself. But this next video is Mark doing a great job of, again, saying markets are random, they're unpredictable, stay disciplined. I don't know when the next up and down is going to be. And that was in 2008, 2009 during a recession when everyone was thinking, was really, really bad. And since then, everything's been great. Okay. So how do you proceed? Right? Is realize crashes happen. Volatility is there. And then when there's more in a boom or one category is doing well, eventually it will come down. Do not panic and do not chase. And understand that nobody can accurately and consistently predict the ups and downs of the stock market. Nor do they know when it will begin or when it will end. So pick a portfolio allocation that you can truly live with no matter what happens. And don't stock pick, don't market time, don't chase. By you, your advisor, and inside of your products. And of course, attend the education and the coaching and stay focused on what's important and stay disciplined. And I know we're human, so if you might think you're going to fall off the wagon. I got a lot of calls during Brexit, and remember it's Brexit. 9 out of 10 times, just pick up the phone and we'll talk. All right, and we'll refer back to this stuff. Okay, and then a last bit of bonus advice: don't leave your old 401ks and pension plans laying around. You'd be amazed how many people forget they had money out there. I mean, it happens to me all the time. I even had a client recently. He lives in Michigan now. He worked in North Carolina and he was a state employee. And I'm like, I told him this. He's like, I got a pension now. I'm like, yeah, they're putting money in your pension plan, out of your check. And he didn't know it. So he called him up and there's money sitting there. So just roll to an IRA. Don't lose track of that money. Sometimes companies go out of business. They change providers. They lose track of you. It's more common than you think how many people lose track of old plans or old pension plans. Pension plans are more common. If you work for a government company or a large corporation, they don't really do those traditional pension plans anymore. But just if you're not sure, just call them up and ask them if you have money sitting there. So that is the conclusion of the class. We hope you enjoyed it.